Hi guys, this is Victor once again. Thanks for joining in. Let's get straight to it. And the market signals for the week of April the 10th. The long-term trend signal still negative. We got a short-term uptrend signal that triggered in late March, um, just some days ago. The macro signal still negative. There has been improvements, but we still not enough to switch it to neutral. And sentiment still neutral. I haven't been able to post much here in Substack, but if you follow me on Twitter, you can get really timely updates on market conditions and signals. Um, for example, after the I post something on Substack, I start posting here, following up, and or just describing what's going on in the market. For example, here March 28th, I described how defensive sectors were catching a bit, and the short-term uptrend signal was activated, and since then, um, you know, we can see that utilities and healthcare have done really well. So and also like I also uh, on there on Twitter, I discussed how the market signal, the short-term uptrend signal, had also flipped. So, you want follow-ups to these videos, check my Twitter, and that's where you can get like the more up-to-date feedback. Okay. We're entering intense week regarding macro inflation data on Wednesday and also Thursday, plus unemployment claims. And Friday we got retail sales. So a lot of macro data coming out that will probably cause market reactions. Probably if inflation is data softer, a bullish reaction. If not, some negative movement in the market. But uh, we also have earnings season starts in earnest on Friday with JP Morgan, Wells Fargo, BlackRock, and Mossy Group. But this is where the banks start releasing their earnings, and we'll probably have, I think, a choppy week. That's my best guess, but we never know. Um, but the market is pulling back. It's getting a rest. I discussed this on Twitter um, here on the end of March. That short term, I think we would expect some profit taking in the coming days, and we were a bit extended, and basically that's what we've had in the general market some last week. This well here, so we got really bullish at the end of March, and basically April. The S&P 500 is a bit down and consolidating its gains. It got pretty extended from its short-term moving averages, so this is perfectly normal, and and nothing wrong with it. No, we're not seeing a big price breakdown or anything. Um, so I'm bullish overall, short-term bullish. Most sectors are in a short-term uptrend, and we recently got another round of breath thrust signals that have bullish implications for a longer time frame. So I'm looking to add to new long positions after the current pullback or consolidation is over. Um, so let's take a look at the market long term. So the we had a long term buy signal here in late January, um, when new highs were dominating new lows, and the percentage of stocks in a primary uptrend was about 50%, plus the technical signal in the Nasdaq Composite was bullish. Then we failed here miserably until mid March, and we got new lows spiking, and the breadth really deteriorated, and the amount of stocks in a primary uptrend dropped quite a bit. Uh, Regarding this new lows and the breadth of stocks in a primary uptrend. We haven't seen much progress yet. We can see that new lows are dominating. We got here some new highs just at the recent peak, but new lows came back the last couple of days, and they're still dominating. So no bullish signal here. Same for the amount of stocks in a primary uptrend, only 38%. But the technical uptrend of the index itself is positive. And actually, the Nasdaq 100 reached new highs recently, surpassing the February highs. So mixed signals here. But a lot of studies came out during the week um, regarding breath thrust. This is from Sentiment Trader, which is a site that I like a lot. But basically, this is a composite of breath measures, and we cycled back to a bullish condition during the rally of the last couple of weeks. And you see that when this has occurred before, the market has had really positive returns and with a very high expectancy. We also got a lot of in FinTwit. If you follow FinTwit, a lot of talk about the sweep breath thrust, and it's basically a 10-day exponential moving average of up issues percentage, or the percentage of up issues, and once again got above 60%, and which is a bullish signal. We got that back in February, but we also got that back in August. So every time, well, here are the stats, they're super bullish. So, well, it's positive. You could say it's positive. But in the current market conditions, we had those signals back in February and back in August of 2022. So, take them with a grain of salt, because we they have tended to occur when the market had reached the peak. But this time, the only thing I'd say it's different is that the 200-day moving average in most indices is starting to curve higher. So we'll see about that. It's hard to have a really bullish stance longer term in the market, with rates being this high and inflation is softening but not really under control. So we'll see about that. I think the most useful tactic to tackling this market has been being a short-term trader, being opportunistic, and not taking the gains that you get. Maybe you can get a 3-5% rally in the indices, or if you trade individual stocks, those moves are gonna be bigger depending on how volatile the stocks are. But basically, I would say it's more a hit and run market, where since I would say June, October, the very really bearish levels in new lows have not led to more downside, but basically the bottoming of the market. As you can see here, when new lows have spiked, we are near the bottom of the market, and actually it's been really profitable to buy fear like it was over here. So, and when people get really bullish, it's been a good time to take some profits. So that's what's working. That's what's been working for me. And until we really see that there's more breadth and less volatility in the market, I will stick to that. But those signals are there, so uh, you see how you can use them, or if they're good for your trading. Well, looking at the shorter term indicators of the market, we see that we got a kind of like a um, when we get this really extreme bullish reading short term, they usually means that we're near a short term top, and with most of until like since 2022, that's basically been the end of a rally, and so we recently got that, and we got the pullback. This time we're holding on pretty well, but we got really extreme, and all these breath thrust signals. There's nothing really special about them. This is my own indicators, but this is the amount of stocks in a short-term uptrend. The way I measure them, and we got over 90%, and that when this happens, a lot of those breath thrust signals trigger, and it means there's just a lot of bullishness, and everybody's chasing stocks at the moment. And this doesn't mean that the market will continue higher. Actually, has meant that the market is about to pull back. But let's see, it's holding on okay here, and we got this golden cross, the 50-day moving average above the 200, which is sloping higher. So that's the major difference this time. So we'll see. Um, we can see how the amount of industry averages, I mean, sorry, industry groups in a short-term uptrend climbed over 80% and crossed the 50% threshold, which is bullish. So we can see that momentum is dropping, from the recent peak, but still at not at bearish levels. Below 33%, that will be bearish. So it's holding on okay. This means we're in a pullback consolidation phase, and we had a really nice rally on Friday, but before a long weekend, and before a lot of earnings data and whatnot coming out this week. Um, we'll see if that. I don't know if this is the end of the pullback, but for now the market's holding, and short term it remains bullish, just on a pullback phase. Um, what else? Oh, here are the sectors I follow the most. Most of them you'll see they're in a short term uptrend, and but most of them, a lot of them are pulling back, and the weakest ones have been biotechnologies, the Russell 2000, and an ARC, which is these speculative growth stocks basically, and defensive sectors really caught a bit last the last couple of weeks. But you could have caught this if you were watching. You see here in by the end of March, we can see that the short-term trend started to flip in utilities, and also in the healthcare sector. And here during these days, the market, and especially technology, pulled back quite a bit from the highs, pulled back about 3%, and healthcare during these days pulled back, less than 1%. So it showed some relative strength, and you can see some basing, of higher lows and higher highs. So it was a pretty low risk entry, and you can catch this, if you're if you have your sectors lined up, and you put a short-term moving average, like a 20-day moving average, and you pay attention of how that moving average is moving, and when you start seeing that this moving average starts to curl up, uh, while other sectors are falling, that's a sign of relative strength, and it can make you participate and get early in these trends. Uh, by the end of the week, everybody was talking about utilities and how they were bullish and blah blah blah. But they're usually, they're talking about relative strength once it's obvious. I put a post on Friday saying, you have to catch trends early and avoid chasing strength when it's obvious. Uh, right now, look how extended healthcare is from its short-term moving average, around 4%. So the place to buy was over here. You see when the short-term moving average was uh, drifting higher, and you had a really low risk in your stop. You could, you have used a recent low, and you could be, 1.5% your stop, and not here. Like, where do you put your stop? Well, you can put, you're chasing higher, and the market can pull back, will stop you out, and keep on moving. And so you have to be smart. When it's obvious, it's not such a good idea to buy. It's better to wait. It doesn't mean it's gonna collapse, but the better entry will be if you wait for a pullback. You wait for this moving average to catch up to price, and then you probably hear that momentum indicator, the RSI, is at 80. Really, it's pretty, overbought. We see it drop a little bit and then remain above 50 and start turning higher with price, setting up a higher low and then moving higher. Then you've got a good entry. So don't chase. That's something that don't fall into the FOMO. Don't try to guess the bottom also. Unless you're doing like a mean reversion trade. No, that's a different thing. But in general, catching bottoms is not a good idea. Wait for the trend to start turning and look for a low risk entry and get long. And if it doesn't work, it doesn't work. But don't get long when most of FinTwit is saying, oh, it's healthcare is so bullish, blah blah blah, and yeah, and it's rallied. What, it's been rallying for what, 8 days already. And now you see the strength. Now that's extended, and you'll get stopped out. I don't think that's a good idea, good trading, and good risk management. Um, and from here, what else? Well, sentiment and the macro, not much to say there. Sentiment is in neutral levels. It rallied during the last days because the market was bullish, but that's this right now doesn't give you any edge. And weekly macro, we got a nice bounce from the lows, but now we're once again dropping lower, and so we still haven't had the amount of weeks of gains in the moving average here, the 21 week moving average moving higher to signal a trend change to neutral, and still remains on negative levels. So that means that it's suggesting that will be an economic contraction moving forward. So that's not reason. That's usually not a good thing. But right now, it hasn't tell us this indicator is not telling us anything new or really useful for the moment. Um, so that's it. I hope this helps you out. Once again, follow me on Twitter to get more timely updates, and let me know about your comments, questions. I'll be happy to reply and help you out, or discuss uh, things market related. So have an excellent week, and take care.